Guys, what I'm gonna do today, I'm gonna make possibly one of the most important videos you will ever watch if you are looking to build a portfolio to generate income. Now, if you are in your 40s, 50s, or if you live abroad as an expat like I am, this is probably going to be one of the most insightful videos for you to generate income, live a good life outside of the United States, and never have to worry about income. Okay, now as you guys know, I left the States about 6 years ago, and I haven't really worked ever since, and I've been living the life. Okay, I've been traveling all over the planet, and I'm very happy with myself. So now I want to share what I do so that you can do it too. Okay, now I have built a stock, bonds, and ETF portfolio to replace my income I had in the States, and I'm gonna share that with you now. Now, of course, in order to accomplish this lifestyle, you might want to cut your expenses in this sense. If you have a house with a mortgage or a car payment or a whole bunch of credit card debt, a bunch of private loans, or other monthly recurring expenses, you might want to cap those first. Like I don't have a mortgage on my house. Now I do have a house. Actually, I have a few of them, but I do not have a mortgage on my house. So I do not have a car payment. Now, if you want to really enjoy the lifestyle, get rid of all those expenses, and I mean, if you can, you buy a house cash, or you buy a car cash, so you don't have the monthly recurring expenses every month, or you can just Uber anywhere. Now, I want to share with you guys this portfolio. And this is an income portfolio, I say, for a 55-year-old man. Now, if you are younger than 55, you might want to change those percentages a little bit. If you are older than 55, you say 60, 65, you might want to increase your income generating asset, and I want to cut some of the appreciating assets. Now let me go through this, what I have here. I've got 20% of my portfolio right here. This would be the green slice between GOF and PDO. Now, why would I do that? Because they pay a hefty dividend monthly. Okay, GOF, I believe it pays about 19%, and that fluctuates. I believe as we speak, it pays about 19-20% dividend, and PDO pays about 11% or 12%. That fluctuates too. Let me pull those one up. On usually what I use is Sigin Alpha. GOF. This is a closed-end fund from Guggenheim, which is an established fund. Today is trading at 11 bucks with 20 cents a share, but you are not worried about the price per share. You worry about the dividend income. Again, this is all focused on the monthly income, and like you guys see, this pays 19.3 nearly percent dividend, which is great. This is gonna do all your heavy lifting for you. If you look at the history, dividend history, and I'm gonna go back 10 years, like you guys can see how it's been really consistent. Okay, even through 2022 when the market dropped, recently with the Iran war, it's been a really good payer. Now if I go back, you can go back all the way to possibly 2008, 2009, during the financial crisis. 2009, there was the bottom of the market. 2008, there was the October 2008, there was when the recession hit. It was paying 15 cents a share. Now, the only thing that you wanna be careful about GOF is the principal erosion, okay? But eventually, you're gonna be fine. If you are focused only on the monthly income, this is gonna be your best friend, and it pays with consistency like clockwork, like you can see here, and you don't have to worry about the principal. Now, of course, the other thing that you want to be careful here is the premium versus the net asset value for GOF. I believe currently is trading a little bit of a premium, like a 4% premium. You can pull that one up. You can see on the Guggenheim website, like the premium trends versus the net asset value. As we speak, it's trading at a 4% premium, I believe, but historically this fund, which is a closed-end fund, was trading over 20% premium, and that's because people like it, given the hefty monthly payment and consistent. Now, the other one that I have in that 20% slide is PDO. I also buy PDI, which is from the same company, PIMCO. They're similar. I believe PDI, they take a little bit more of a chance and pay a higher dividend. Let's see the dividend for PDI. Okay, it pays you over 15% dividend, which is great. Okay, on the history, like you guys see, this pays monthly, and from time to time they have a special dividend. The price of this you wanna look at the principal erosion, but if you go back from inception, it was down 30%, okay, but it's been paying you over 15%, so overall you are fine. Now, the other thing too is that you might want to check the same thing with this, the premium versus the net asset value. There used to be a drop here, of course, and then in 2022, when all of those funds, along with the bonds, dropped for inflation, it was elevated, the Fed. But again, I feel pretty safe buying PDI or PDO at the current levels. Now the 15% slide, which is the purple one, is JEPQ. JEPQ, they make money by selling cover calls out of the money of about 50% of their portfolio, which is Nasdaq tech heavy. Now you guys might already be familiar with JEPQ. It pays about 10% dividend. This is one of the best things that anybody can do, especially when the market is nearly all-time highs like it is now, or when the market is going sideways. And that's because when the market goes sideways, this ETF usually gives you a better overall return than the Nasdaq QQQ. And why is that? Because of course when the Nasdaq is very expensive, even if you buy at those levels, really, history teaches us that with the Buffett indicator nearly all-time highs and the Shiller Cape ratio, which is 2 nearly all-time highs, actually only twice in history the Shiller ratio was at this level, and that was right before the 2000 dot-com crash and right before the 1929 recession. And history shows that if you buy stocks at that level, your return over the next 10 years, it's basically negative, flat, or in the best case scenario, it's 2%. 2% on your money over the next 10 years. So you guys can see like this portfolio makes even more sense if you keep into consideration that the market is trading at absurd levels right now. Dividends on this one, this is a very good payer. This pays 10.5% dividend, very stable, and it's also a good position JEPQ to capture some of the appreciation, like you see. The only way that JEPQ is not gonna be a good buy, it is if the QQQ was to shoot up. If the QQQ was to go way up, well then in that case you were better off buying the QQQ. But no one has got a crystal ball. And really at the levels the QQQ is trading now, I don't see that happens, to be honest with you. And right now we're still experiencing steak inflation, oil price nearly $100 a barrel. You tell me how the stock market is gonna go up. Stock market went down 5 weeks ago when the Iran war started, and now it's trading up like crazy when we still haven't solved the war. I mean, there have been peace talks, but I believe we're still beginning from scratch, and we're still at square one with that war. So I believe that the market has priced in a lot of optimism that it hasn't really concretized. So JEPQ is a great buy. I possibly think that JEPQ is my best buy here. I got 15% on my portfolio. Now what's the orange there? The orange is ASGI. ASGI is a fund. It's a fund that sells cover calls on infrastructure like AI infrastructure, power plants, cables, pipes, anything which is utility related, okay? And as you guys know, with data centers now, they're gonna require a lot of power, and that's why I have ASGI in my portfolio. If you look at the holdings, utilities nearly 30%, industrial over 27%, energy 10%, communication 7%, real estate 3.5%. So here you can see here the top 10 holdings for ASGI. Now notice something, a lot of those holdings are international. So if you want to have an asset which is not correlated to the US economy, not correlated to the NASDAQ, and at the same time it pays you nearly 12% dividend yield, annualized dividend, this is the fund for you. And also it's unrelated from inflation, because it doesn't matter what inflation does, people are still gonna need the utilities, they're still gonna need to pay the power bill. And again, data centers are gonna take up a lot of the power on that grid. So great fund. Look at the history. If you go back 10 years, it actually raised the dividend over the past 10 years. So I like this very much. Next one in line is I have 20% in TBLL. Now guys, TBLL is the Invesco short-term Treasury bill ETF. This is the 1 to 3 month Treasury bill short-term. It's pretty stable. It is trading at about 105, and this pays you 4% annualized dividend with an ex-dividend about the 20th of the month. Now the good thing is that while those other ones they were paying you about the 1st or the 15th, that pays you on the 20th, so you scatter your income. Now usually you don't buy TBLL or any of those to generate income, because you're only talking about 4%. But this is a great position to have in your portfolio, because this is gonna be your dry powder, guys. If something was to happen to the stock market, anything might happen to markets, right there you have 20% of your portfolio ready to be deployed to buy your favorite stocks, or you might even deploy that capital into those funds that we were just talking about. Now, like you see here, the dividend yield, it's about 3.8, just shy of 4, but that's gonna fluctuate, because if the Fed raise rates like I am sure that they're gonna do, with sticky inflation, oil price going up, I believe that the Fed has no choice to raise interest rates, and when they do, you're gonna see the spike there in the TBLL to 4-5%, and that's gonna be great. Now if you look at the, of course, the consistency, dividend history. Now of course right there where you see that the interest went down, there was when the Fed dropped the rates to 0. Now I also want to tell you that any portfolio should have treasury bills in it because it's a stabilizer. Now, if the rest of your portfolio drops 5, 6, 7%, right there you have you have something that is gonna pay you 5, 6%. So you have your money right there when you need it. I have another 20% in dividend stocks. Those are the high dividend stocks. I got Realty Income, ticker symbol O. Verizon, symbol VZ, AGNC. Now, Realty Income pays you monthly dividend, and it's a very stable company, raising revenue. Of course, most of you guys possibly already know dividend aristocrat. And Realty Income, they own some of the most prestigious properties. They have leases with Walgreens or CVS or some of those commercial companies, long-term leases, very stable. Verizon, everyone knows Verizon. It is a stable company. I think the business model is not going anywhere. Everyone is gonna need to get connected to the internet. Actually, they have a partnership, I believe, with Starlink of Elon Musk or ASTS, because eventually the internet is gonna be satellite, at least to cover the rural areas, or to cover internet that we are on a boat or you are in a mountain. Regardless, I believe Verizon is a great company. And then AGNC, this is another real estate investment trust, REIT, that pays you about 10%. And I also buy those to sell cover calls against them. Oh, a Realty Income. Let's see the dividend on there. Actually, recently it went up. I believe it's a bit high priced, but what you guys do, you want to DCA into it. It's got a dividend yield of 5%. In the meantime, you capture some of the appreciation, dividend growth, 32 years. 32 years. The ex-dividend date is going to be April 30th, payout May 15th. Frequency monthly. If you look at the history, over the past 10 years, wow, they raised actually the dividend over the past 10 years. Great company, great stabilizer. The other one in line was Verizon. I believe Verizon pays like a 6% dividend. Those are good companies because the stock price doesn't move a lot, and they are stable companies. You can DCA into it. When the price drops, you're gonna buy more shares of it. When the price rises, you buy less shares of it, but you still collect a good dividend. If there was to be a stock market crash or stock market correction, you can buy a whole bunch of those at a higher yield, which I love. Verizon dividend history, very consistent over the past 10 years. Okay, you get that. And the other one is AGNC. Again, this is a REIT. Let's see the dividend on this one. Okay, the dividend has been coming down a bit, but it still pays you a 10% dividend. Now, the good thing about those stocks is that you might want to sell cover calls against them once you have 100 shares of it at least. See, the good thing about a GNC is that they have a weekly expiration. So like a week from today, you can sell a cover call and you can make $6, $7, $8, okay? Selling it slightly out of the money. Now, of course, if you sell it in the money, $29. Okay, if you go 2 weeks out, May 8th, you sell a call. Okay, if you sell it right in the money, you can make $25. Deep in the money, you can make $100. Now, of course, this depends what price level you bought it, and I recommend that you only sell cover calls when you have equity in your position, and I would recommend to selling it out of the money. It depends on your objectives. If you are more focused on the dividend income and you want to keep the shares, you might want to sell it way out of the money, and you can make a few bucks. If you are more focused on the premium, you might want to sell it at the money. If you are not worried about losing the shares because you already have a whole bunch of them, you already have a whole bunch of equity in it, and you have a good opportunity to make more money on the premium than you would on the dividend, well, then go ahead and sell your cover calls deep in the money. Now, if you look at Verizon, I believe Verizon has a monthly. Of course, they pay dividends quarterly. But if you are interested in the options, Verizon too, they have weekly options. Okay, so you can make money with Verizon by selling weekly. I mean, you don't have to sell it weekly, but you have the opportunity to sell it weekly. Like a Verizon, if I was to sell a cover call May 1st, wow, Verizon has got some good deals selling the cover calls because, I mean, you can sell a cover call at 49 and you can pocket $50 with an expiration on May 1st. It all depends on your price level and your financial objectives, but like you guys see, there are a lot of ways here that you can make money. I would recommend that you DCA into it, wait at least 3, 4, 5, 6 months to a year, and then see where you're at. If you have equity, you can make money by selling cover calls. Okay, and the other one was realty income. And now I do know that realty income pays monthly dividends. I just want to check what is the expiration of the options on that. Okay, notice something. On realty income, you can sell cover call, but they have a more scattered expiration. Like you go from May 15th to June 18th to September to December. So let's see if I want to go out May 15th, selling a cover call. Yeah, but you are 3 weeks away. I would rather, yeah, you can make $70. They're not very liquid. You go from $70 to $15. I would rather selling cover calls on Verizon. Really, you can do everything with Verizon. Income, appreciation, not so much, but you can do cover calls and doing it with consistency with Verizon. And the good thing is that the price is pretty stable. You're not gonna make a lot of money on the principal or lose a lot of money on the principal. The only reason why I also buy REITs is for diversification. If you want, you can add Pfizer, PFE. If you want to diversify with something in healthcare, you can do the same thing as you would with Verizon. You can do it with Pfizer. But Verizon really is your one-stop shop. Now, next in line is CCD. CCD is an income generator. CCD is from Calamus. CCD pays about 10% dividend. It's a bet on credit. They use a lot of debt to generate that. Let's see their holdings. Okay, Momentum, Western Digital, Akamai, Bloom Energy, Centerpoint. They have 609 holdings here. The good thing about this is that the price doesn't react so much like they do with GOF or PDI. Let's see on the dividends here. Pays nearly 10% dividend with a monthly frequency. Ex-dividend day was April 14th. You're gonna get the money in the bank April 21st. Let's see the dividend history. Dividend history over the past 10 years. Now, I really don't know, this thing has been around 10 years, but over the past 5 years at least, they've been paying 20 cents a share. 20 cents on a $24 share. It's pretty good deal. I like it. I like it very much, and I have 5% of it. And the last but not least, it's a 5% that I allocate more like speculative income, and that is on the yield max products. Now, those products are a bit risky because you're gonna make a lot of money on the income, but you might lose the same amount of money on the principal, but it's a bet. Usually I buy NVDY, which are cover calls on Nvidia. NVDY. And now the good thing about this, and they pay dividends weekly. So in the meantime, you are waiting for the monthly dividend, or in the meantime, you are waiting for the big check quarterly, or whatever. This is gonna boost, you get income weekly, and you can redeploy into those other funds. Okay, now I like this one, Nvidia. Now on this one, the dividends, they pay hefty dividend, and now a 65% annualized nearly dividend, and they pay again weekly. Now, of course, if you're not a big fan of those, you can just skip this phase and put everything into those other funds, or just put it into T-bills. Over the past year, like you see, the dividend is all over the place. The other one that I buy on this one is, of course, there are a few. There is CHPY, I think. Okay, CHPY, they sell cover calls on semiconductors. Now this went up because recently semiconductors went up. Dividends. I believe that this is a newer fund that pay nearly 35% dividend annualized, and they pay weekly. Look at that. Now I wouldn't buy this because now it's trading up. Also they have Ulti, ULTY, Misty, MSTY, cover calls on MicroStrategy. They have YMAX. YMAX, I believe it's a fund of funds where basically they take all of those cover calls and they come up with a better combination. Like you see, they got 8% in strategy. Regardless, they have Moderna, Netflix, HIMS, Palantir, PayPal, Airbnb, XYZ, Amazon, Meta. You know, they change those percentages in order to deliver to you guys 34% income. The other one that you might want to look into is QDTE. QDTE is from Roundhill, and I think it's fairly new. They write cover calls on the Innovator 100. That's a diversified asset. They do have some T-bills, but the good thing about this is that they pay a hefty dividend too. 45% dividend. Let's see the dividend history on that. Again, it carries risk, guys. That's why I only allocate 5% to a combination of those. I only do it for the weekly income. Dividend history. Okay, you see it right there. Over the past 5 years, they've been paying those dividends. Again, you might wanna do your own due diligence, because what you make in the dividends, you might lose it on the principal. But again, this one portfolio is for you guys to make as much as you can on your monthly income and enjoy your lifestyle. If you are doing this for the next couple of years, you might want to buy some of those yield max. But if you want to do something that you set it and forget it for the next 30 years, I want to stay away from those and be more focused on T-bills, Guggenheim, PIMCO, you know, your house names, and I would stack a whole bunch of Treasury bills. And with those, when the opportunity presents itself, you might want to redeploy into some of those funds, or you want to redeploy into some of your favorite stocks. Or if you are a risk taker during a huge stock market crash, you might want to use some of that Treasury bills to buy your high growth ETF or your leverage ETF, your TQQQ, which is your XXX leverage ETF on the Nasdaq 100. I would only buy TQQQ when it drops to a very low level. Like if I was to look that one up, I would only use my Treasury bills or a portion of my Treasury bill to buy the TQQQ at historically low levels. Like, notice something. In 2023, the beginning of 2023, you know, 2022 the market went down a lot. TQQQ was trading at $10 a share. At the low of the pandemic, $7 a share, and today it's trading at nearly 60. So as you guys see, you might wanna get the TQQQ only when there is a S1 event, a pandemic, a big something huge. If not, stick to what you know. So going back to the income portfolio, I believe that this is a great choice for anyone in the right mind. Also, the way I came up with this, it was through, of course, Gemini, and I want to send this one portfolio to Gemini and see what he has to say. He or she.
The pie chart you've put together provides a clear visual of a diversified income strategy. It balances more conservative ballast with aggressive yield generators to reach a target of $150 to $300 per day, which scales to roughly $4,500 minus $9,000 per month. The portfolio's overall yield and principal amount are the two levers you can adjust. Portfolio breakdown and observations, sector, allocation, representative tickers, role in portfolio, fixed income, 20%, TBLL, stability and liquidity, protects principal. Core dividends, 20%, OVZ, AGNC, established payers, provides a mix of REIT and telecom stability, CEFs, 20%, GOF, PDO, strategic income using leverage, typically higher monthly yields, infrastructure, 15%, ASGI, real asset exposure, often offers tax advantage distributions, covered calls, 15%, JEPQ, equity exposure with lower volatility, generates premium income, speculative yield, 10%, YMAX CCD, the yield boosters, high distributions but higher capital risk, tactical considerations for an expat lifestyle. Since you are managing this for a life in Medellin, a few technical nuances might help optimize the cash flow. Yield on cost versus current yield. For the 300 per day upper goal, IF your total portfolio yields AN average OF 10% annually, you would need a principal OF roughly $1,095,000. If the yield averages 12%, that requirement drops to about $912,500. Distribution frequency. Your chart correctly identifies monthly and weekly payers. This is excellent for budgeting in a foreign country, as it mimics a steady salary rather than waiting for quarterly lumps from stocks like VZ. The yield trap check. With high-yield CEFs, GOF, and ultra-high yield YMAX, keep a close eye on the net asset value, NAV. If the NAV consistently erodes, the distribution may eventually be cut, which would threaten your daily income target. Tax efficiency. Depending on your tax residency status while abroad, you might want to look into how distributions from CEFs, which often include return of capital and covered call premiums, are taxed compared to standard qualified dividends. Quick calculation table. To stay within your 150 minus 300 per day range, here is the required principal at various blended yields. Target income, 8% yield, 10% yield, 12% yield 150/day, $54,750 per year, $684,375, $547,500, $456,250, 300/day, $109,500 per year, $1,368,750, $1,095,000, $912,500. Are you looking to keep the allocations exactly as they appear in the chart? Or are you considering shifting some of the 20% fixed income into higher yielding sectors to lower the required principal for your Medellin move?
Yeah, I believe. I believe I'll keep the weights like you recommend. But I had another question. When would you suggest to buy the above mentioned positions? Would I buy in a lump sum like a GOF or PDI, or would I DCA into it like Realty Income, Verizon? What is your recommendation? Or should I wait for a market correction or market crash to allocate my money into them? Thank you.
Deciding when to pull the trigger is often the hardest part of income investing, especially when you are looking at specialized funds like CEFs, GOF, PDI, versus stable dividend giants like Verizon, VZ. Given your goal of generating 150 minus 300 per day for your life in Medellin, here is a tactical breakdown of how to approach your entry. 1. The lump sum versus DCA strategy. As of late April 2026, the market is navigating some geopolitical tension and sticky inflation. For CEFs, GOF, PDI, these funds often trade at a premium or discount to their net asset value, NAV. Recommendation: DCA, dollar cost averaging. Because funds like GOF can trade at high premiums, buying all at once risks a premium collapse. Buying over 3 to 6 months allows you to capture different entry points and helps smooth out the volatility inherent in leveraged funds. For core stocks, VZO. These are mature companies currently facing mixed analyst sentiment regarding interest rates. Recommendation: opportunistic, DCA. If you see a red day where VZ or O drops 2 to 3% without fundamental news, like a dividend cut, that is a prime time to scale in. 2. Should you wait for a crash? Waiting for a total market crash is a double-edged sword for an income investor. The cost of waiting. If you wait 6 months for a crash that doesn't happen, you lose 6 months of distributions. At a 150 per day target, that's roughly asterisk 27,000 in missed salary asterisk you could have used for your Medellin relocation. The compromise. Keep your 20% fixed income TBLL as your dry powder. Buy your core positions now with 80% of your intended capital, but keep that 20% in TBLL, which is currently yielding well in this higher rate environment. If a correction happens, you can rebalance that TBLL cash into the on-sale equity positions. 3. Entry checklist for your specific tickers. Before you buy, check these 2 specific buy signals for your portfolio. Ticker. What to look for before buying PDI/GOF. Premium to NAV. Check if the premium is significantly higher than its 1-year average. If the premium is over 20%, wait for a dip. VZ/O. Interest rate sentiment. These stocks move inversely to the Fed. If the Fed is hawkish, keeping rates high, these usually stay suppressed, giving you a better entry yield. YMAX. Ex-dividend dates. These pay weekly/monthly. Some investors prefer buying after the ex-dividend date, when the price typically drops by the amount of the payout. Summary recommendation. Don't wait for a crash that may never come, but don't go all in on a single Tuesday. 1. Allocate 50% now to start the cash flow. The income engine needs to be running. 2. DCA the remaining 50% over the next 4 months. 3. Keep the TBLL portion liquid to act as your crash insurance. If the market drops 10%, sell the TBLL and buy more JEPQ or O at a discount. Does your timeline for moving to Medellin require this income to be fully live?
Guys, I would say that what you do, you start dollar cost averaging into PDI, GOF, and JEPQ. okay? And of course, you can buy treasury bills on the side too with consistency. Then, when the opportunity presents itself, it doesn't have to be a stock market correction or a crash. When the opportunity presents itself, you buy Realty Income, Verizon, AT&T, and Pfizer if you want. And if there was to be a stock market correction, that means that the S&P 500 is 10% from the highs, or a stock market crash. Let's see, if we get into a bear market, that means that the stock market is 20% from its highs. Well, in that case, you're gonna buy into those more speculative assets, the yield max products, or the QDTE that sells covered calls on a daily basis. I believe that is the strategy, and I've been doing it. I've been here 6 years. I just wanted to share this, how I fuel my lifestyle. And of course, this is only an example. It depends on your financial objectives, where you are on the planet. You might actually need less than $150 a day. So I'm gonna wrap this one up here. Let me know if you have any questions. Feel free to reach out, and we can connect. And I appreciate you guys for watching, and happy investing, everyone.